Well, good afternoon, everyone, and thank you for staying. I know that was a great headlining session there, and hopefully we can follow up with some great insights. My name is Sinthunont. I'm at Preqin. I cover asset allocation research. So in case you don't know, Preqin is a data research and solutions provider focused on alternatives. So everything from private equity, hedge funds, private debt, as we talked about earlier today, and also venture capital as well. So joining me, we have a set of panelists who I would say would have a great kind of mixed views on what's going on in asset allocation from macro, tactical, strategic. So hopefully it will be an engaging session for everyone. And please save your questions for the end. There'll be time for that because we have some 30 minutes to talk about a very big topic, guys. So appreciate that. So maybe just a quick introduction from everyone before we begin. Aaron, maybe go first.
Sure. Aaron Bennett, Chief Investment Officer of UPP. We're the newest kid on the block in Canada, trying to execute on what is commonly referred to as the Canadian pension model. We manage pensions for a number of universities in Ontario and look to grow over time as we add more universities as well.
Borislav, Vladimirov. I'm microstrategist at Goldman Sachs. Previously, I was partner and portfolio manager at Rocco's Capital and Brevan Howard.
Dirk, I run global macro and asset allocation research at Citi.
Perfect. So just to set the scene, Preqin collects some data on asset allocation globally. We've done it for a while now. So just looking back, in 2019, global institutional asset owner asset allocation on average was around 15%. End of 2023, that's gone up to about 20%. So obviously, the role of alternatives is growing, and obviously that hopefully sets the scene for the conversation. But I really want to focus on the macroeconomic current day, maybe touching on the points that were raised during the last session, and seeing how maybe that's going to impact asset allocation going forward. So perhaps start with you, Dirk. What's your thoughts on what the major factors in terms of macroeconomic sense that might impact asset allocation?
Yeah, thanks a lot. Yeah, for us, the big question we are struggling with is basically how to hedge against inflation risks, right? I think there are many reasons to believe why the shocks to inflation on the deflationary and the inflationary side will be a lot more symmetric than over the previous decades. And of course, as we all learned in the last years, the 60-40 portfolio does not do very well when you get an inflationary shock rather than a deflationary shock. And so the question is, what assets help you to manage against potential inflationary shocks, which could come, of course, from from the greenflation, from the defense budgets, from the general idea that the governments really socialize most risks that happen, like COVID. And so what do you do about that? And unfortunately, it's just a lot harder to find assets that hedge you against inflation or against stagflation than it is against deflation. And in particular, I think we found out in 2022 that a lot of the more traditional inflation hedges just don't work very well. They only work when the Fed is not hiking, so they work against inflation that's not attended by the policymaker. So yes, gold goes up, Bitcoin goes up, tips work well if there's inflation and the Fed doesn't hike. But once policymakers wake up and do attend to these pressures, they stop working. Equities stop working. And so that's one big question. And the dollar does work. Infrastructure does work, although the data we have for infrastructure is not going back all that far, so maybe that is too optimistic. But a lot of the other things that work, and I think that will be important, are sort of the trend-following strategies, the CTAs, the macro hedge funds, the sort of general momentum plays, who are one of the very few assets that do quite well in these times. And so the question is, where do you take money from to allocate more to these type of assets? And government bonds are an obvious issue, and we think a lot about the increasing supply of government debt at the same time when actually supply of equities is shrinking, as you know, with all the buybacks. So that I think is the biggest macro issue we really grapple with.
And Boris, any other thoughts on that?
I mean, look, we think very much in line but we're probably focusing a bit more on nominal growth rather than just the inflation side. And when it comes to asset allocation, you have questions of obviously diversification as well as horizon. And in the developments of the past 10 years, I would say regulation has been an important change to the market environment, and we see actually increasing diversification out of regulation into alternatives, right? That's one important element. And it's now catching, so to say, the attention of regulators. So that's kind of a circular process, but definitely it is a trend that is likely to continue in future. And when it comes to horizon, I think, again, the real returns do matter. And the major question of asset allocation when you think about the 60-40 is whether the assumption that the correlation is going to flip at inflation above 3%, I think the jury is still out on that. And people do overweight bonds in the last 6 months because they say the long-term real yields look quite attractive, but that's based on the assumption that the long-dated break-evens are correct. If you look at the relationship between equity price-earnings ratios and the implied real yields, you have to ask what is real. Is it the price-earnings ratios or the real yields? And if equities are right and bonds are wrong, then you have a case for staying in equities in the asset allocation and maybe increase alternatives, right? And I think this is probably the major debate in the market at the moment. Are the long-dated break-evens right or not?
And I know you have a different perspective, a little bit more focused on the medium to long term with your asset allocation. But in terms of today's current economic picture, the interest rates and inflation, are these all big concerns for you? And how is that kind of playing into the asset allocation going forward?
Yeah, so I'd say I don't think I'd have a lot to add on the inflation side of things, but as an inflation indexed benefit or fund, it's particularly important. And we're also in a country that has stopped issuing real return bonds as well. Our government has, so we have fewer options, so we have to range a little bit further. So it is quite important. And it is something that from an investment perspective, I think the tools are not there in the same way as they were back the last time we had inflation. As opposed to the other side of the coin, I think rates, this is something that is higher, although as I remind many of the younger folks on my team, it's not the highest it's ever been or anything. This is certainly around back when I would have been starting my career 25 years ago. We saw similar rates here, but it does impact asset allocation, particularly in pensions. And I think particularly in the UK, you see a lot of UK pensions that are now funded. We're fully funded, and we've been fully funded for a while, but there's a number of UK pensions that are now fully funded, and so the opportunity to de-risk has popped up, and that inevitably will have some impact on your asset allocation, whether you're there or you're close. Because as you get close to thinking about de-risking, you really start to think about the composition of your portfolio and what you'll be able to hand over to an insurance company or to purchase an annuity with. So that necessarily is going to have you focus on cash flows and deviating away from the alternative side of things, particularly on the illiquid side of things.
Perfect. So now, having looked at some of the funded ratios that we've seen on aggregate of the UK, fully funded on aggregate terms. The last 2 years, US, Fortune 500, Fortune 1000, again, fully funded or even overfunded. You mentioned perhaps this is a headwind for the alternatives because of the illiquid nature of it. But are you seeing that in your local market as well? Would that be able to, would Canadian pensions be able to de-risk?
Yeah, Canadian pensions, we tend to be less mature.
Okay.
So I think the opportunity and the desire to completely de-risk is lower. We also find that, and I think this is true in the UK market as well as the US, is the overall size of the annuity market or the willingness of insurance companies to take this on is limited. Mm-hmm. And I think that, so it could present a little bit of a headwind. It could also present an interesting opportunity, and I've heard of some groups down in the US and seen some in Canada too, where if they can de-risk a part of their pension, their willingness to take more risk and to look at illiquidity and to think about the growth side of their asset allocation, they may be able to stretch a little bit more than they otherwise would.
Okay, understood. Now, we talked about the macroeconomic factors that play into asset allocation, but obviously there's some structural changes that's happened over the last 2 or 3 years, some stuff that was mentioned in the panel earlier. So perhaps we can talk about some of those. What kind of non-economic factors that you think are going to impact asset allocation decisions moving forward? You can separate that out by medium or long term, that's fine. Perhaps, Boris, what's your thoughts on that?
Well, obviously, artificial intelligence is a very important driver. And there, I think, the forward-looking investors should be focusing on securing and maintaining strong data pipelines. I think that's by far the most expensive and tricky to properly organize part of the AI pipeline. And you need a strategy, you need strong partners, because expertise is very dynamic in the field, and you need to build also cross-border expertise, especially if you're based in a smaller country. You need to figure out how you get data from the large locations that will define nominal growth and investment returns. So I would say that will be my number one focus in terms of forward-looking impact.
Maybe I can just add, so the AI issue is fascinating because it has two components, I think. One is using it as a tool, but the other is, of course, the investment opportunity set itself. And the numbers that were quoted earlier of the IMF, that 40% of the jobs will be at risk in some shape or form, or that half of them will be negatively impacted, makes AI basically a great hedge for human capital, right? I mean, human capital for most people is the largest chunk of their general portfolio. It depends a little bit on your age, of course, and human capital sort of falls over time, and financial capital rises over time. But it's still an extremely important asset. And just given how important AI will be undermining that assets for many people, I think it will just be a very important part of a portfolio. It's like, people, I think the chart of the employment of in bookstores and Amazon, right, is going like that, and of course it's a well-told story and example, but I think it's sort of right, and this time it's just on a massive scale. So I do think AI as an investment theme is also important for diversification. But the second more structural point is, of course, this whole friend vesting, as you might call it, sort of the equivalent to the friend shoring. And that, I think, really just means China in some sense, because all the other countries that you might avoid are just small, not very important for global portfolios. And so yes, we see that, right? We saw this rush into CGBs for decades, and now we're seeing the opposite. We're seeing outflows out of CGBs, and certainly before the US election, that's not going to change, and presumably it will not change after the US election. So, so that geopolitics impacts to a much larger extent investment decisions than it ever has. I think that will stay with us, though I also do think it's more or less an isolated don't invest in China sort of case rather than something that impacts portfolios much more broadly than that.
Perfect. And Aaron, when you think about, kind of, again, more long-term, the trends like AI, I think demographics was brought up as well. Are you thinking about those things and how it impacts kind of what to allocate, and I guess which managers to go with? What level does it really impact those decision-making?
Yeah, I think these longer-term issues like AI, like the demographics, drive both asset allocation and also relationship with stakeholders. We are a jointly sponsored pension plan, so we're sponsored by a number of unions as well as faculty associations at universities. And AI and what that's going to mean for the future of work is something that they want to understand a lot about. It's also an input to our actuarial models in terms of the overall growth. And the demographics are tricky as well, because you have a large group that is retiring. Professors don't actually retire; they just kind of disappear. They fade into the mist, I guess. But they work for a very, very long time, and there hasn't been a rejuvenation of the folks underneath them. And in fact, there's been a long delay there as well. And I think that's reflected across the economy. So we think about the cash flows coming in and what that's going to mean from a liability perspective. And from an asset perspective, it's also something that I think we as a mid-sized pension don't necessarily have the capacity to truly understand all the applications and implications. So we spend a lot of time looking for partners that that maybe do the conventional stuff in real estate and infrastructure, private equity, or on the absolute return side of things. But they're spending time and they're making investments in AI, and they're able to talk about how they use that within their strategies as well.
Yeah, perfect. Maybe I'll stick with you, Aaron, after this question. One of the, I guess, challenges with alternatives is the liquidity side. And obviously long lockup periods, you might not see your capital for 10, 13 years at some points. So quite, I guess, unique. How do you see that liquidity profile changing? From our side, obviously, we see in the growth of the secondaries market as a way to offer, I guess, increased liquidity, increasing. Obviously, you look at the AUM for both GP and LP-led secondaries has gone up significantly. Obviously, some new structures out there, evergreen type structures, new fund types for retail investors perhaps to get involved, or at least DC pensions to get involved. So what's your thoughts on the liquidity profile going forward for alternatives?
Yeah, it's an area we think a lot about because we have a growing allocation to both illiquid and liquid alternatives in our target asset mix, and that means that we need to be thinking about liquidity. I think relative to what we've seen in the past is I think the cadence of liquidity is less certain and the volatility is higher. I think we've all been reminded, anybody that's in a lot of growth private equity, you need to understand that your pacing model is probably wrong, and you're going to need to rethink about what you're going to do with that. It also means that if you're going to participate in the secondary market on the sell side, you need to think about values because you will be taking a bit of a discount to NAV as well. We have seen a lot more proposals for continuation vehicles and some really interesting proposals on the buy side for secondary vehicles. So I think it is an interesting element. I'm not quite sure what to make of the proliferation of open-ended funds or things that would potentially democratize some of these elements, because I believe that depending on where your allocation is, if it's going to be sizable, you need to be in a position to manage your liquidity more actively, and you need to have a few more tools available to you. So it will be an interesting period. I think it will be one that will probably normalize over a period, but for right now, it's looking at quite a choppy setup in terms of the cash flows or distributions that you can expect from your GPs.
If I can add to that, actually, the quantitative investment strategies, which have become more popular, offered by a number of banks, they combine some very interesting qualities. They have usually daily liquidity, and the reason is basically they do tap the OTC liquidity pool that the banks see. They do have AI in various ways, in the simplest form by the actual algo management of the execution or delta hedging. And you get substantially different return outcome if you, for example, delta hedge intraday rather than daily. Also, they actually provide exposure to non-linearities in the market's return structure that would usually be associated with alternatives, right? So I think as a combination, that's a very interesting area to explore.
Perfect. Just moving on now to look at maybe where the opportunity lies in terms of these alternative asset classes outside the ones we've kind of talked about, and looking at the future kind of regime that we might be entering or are in now. Dirk, what are your thoughts on some of the opportunities? Is it in your traditional alternatives, or is it Bitcoin or all the cryptocurrencies are kind of good opportunities? What do you see are well placed to benefit?
Yeah, in general, I think as I mentioned, the big allocation needs to be given to these sort of global macro CTA momentum strategies, just because it's the only thing that works in high inflation or stagflation. But that's, of course, at this stage, not the base case. So the question whether there should be any crypto in the portfolio is obviously a good one. I mean, I would say maybe adding on to the earlier speaker, yes, maybe the intrinsic value is zero, but I think if the case for Bitcoin to disappear again is gone, right? I mean, so basically, it survived 2 crypto winters, and it survived the SEC, and so it's here to stay. The question is, what is the fair value and what's the right price? And I'm certainly not in a great position to answer that question. What I would say is, it's a very nicely trending asset, which means it really lends itself well to trend-following strategies, and you can meaningfully increase the Sharpe ratios of crypto investments if you run a very simple trend-following around it. And there are obviously plenty of funds that do that. So and yes, you can argue that it should be part of an asset allocation. With gold, I think, again, it was discussed a bit earlier. I mean, Citi has a $3,000 price target, so we are broadly bullish. But I mean, one should realize it will not protect you against inflation that the Fed is actually addressing, hiking rates aggressively. I mean, it has, of course, this sort of, aggressive buying of central banks and maybe of Chinese retail investors. But I mean, certainly the Chinese retail investors at some stage will stop too. So I would say, you should be part of a portfolio, but you should not expect gold to bail you out if you're talking about a higher rates environment necessarily. Broadly speaking, I must say, I still think, US equities are a good bet. I mean, they have basically oligopolistic companies that are at the technological frontier. Very tough to argue with that, I think.
Anything to add?
If I could add something, actually, in respect to Bitcoin, the market generally has deficiency for high vol assets